problem that we're facing now with some of the bank capital rules that are currently in effect is as they pertain to bank-affiliated clearing firms. And remember, there are only a very small number of clearing firms that clear options market making business. There are three, more or less, major ones. Is that those banks have capital requirements now, which really penalize that business. It puts an artificial cap on the amount of liquidity that market makers can provide to the marketplace. It effectively puts a cap on open interest that market makers can hold. And that's important because those market makers then lose the ability to provide that price transparency and provide that risk warehousing service to investors. The other issue is one of the other issues is there's no delta adjustment. So to the extent that I have a position that's simply long a 100 delta option or short a 100 delta option, that position in some respects is treated as having the same notional exposure as if that were a 5 or 10 or 20 delta option, which materially represents less risk to anybody holding that position. Another problem is, and really a fundamental problem, is that a bank-affiliated clearing firm that holds collateral from a market maker could actually see their capital requirement for a given options position that belongs to that market maker be higher than if the bank had simply taken on that position on a proprietary basis. And that clearly runs counter to the stated objectives of Dodd-Frank and other regulations enacted around the world, in the US and Europe in particular, since the financial crisis. So there are a number of senses in which these things kind of taken together just don't really make a lot of sense. And we now as an industry are coming together to look for ways to solve this problem so that the tax that this ultimately imposes on end users and investors in the options product can be to some degree ameliorated. And something we've seen over recent years that's been talked about very extensively in this industry, of course, but the proliferation of auctions and other mechanisms that siphon order flow away from being able to interact with posted and displayed bids and offers. And of course, the best advertisement that we have as an industry is the fact that a retail investor can pull up any symbol, equity ETF index, look at an options chain, see hopefully reasonable prices and think, oh, there's something for me to do here. The problem that's taken place, of course, is to the extent that more and more of those retail investor order flows end up executing through auction mechanisms or other mechanisms that don't necessarily touch those displayed markets. There are a number of factors at play here in the competitive landscape when it comes to technology and the speed arms race and the risk of being picked off by a low latency participant who's got a really fast news feed or is scraping Twitter very quickly. A lot of these risks are new risks to liquidity providers in some sense, at least in terms of scope, coupled with a regulatory environment where, whether it's through bank capital rules or other things, it's potentially more expensive or more difficult, or there's just a ceiling of some sort imposed on liquidity providers and their ability to make markets. All those things together really do, I think, emphasize the importance of these concerns about liquidity fragility. And it can be tough to see. There's academic literature that talks about ways to measure price impact and the extent to which you expect a big order to get filled at a worse price than a small order. We're concerned that the current environment is increasing the risk for participants, for investors, and for the marketplace in the event that there is, at some point in the future, which is a matter of when, not if, a price disruption event. And so I think it's important that we look to address these issues before rather than after that happens.